Welcome to Smashing Through Walls with Carla McGee. Whether you are just pulling up a seat to the table, breaking a glass ceiling, or smashing through walls, grab your favorite mug and join us on the first and third Friday at 11 o'clock for candid conversations with industry experts and decision makers as we navigate and explore all the things related to real estate and community.
Hi, welcome to Smashing Through Walls with Carla McGee, where we don't just want to break the ceiling, we want to smash the walls. Today, I'm super excited to have Ken Starks in the office with me. Ken is a mortgage broker, lender. How would you?
I am currently functioning as a mortgage broker.
Okay.
Yes.
And that means you get to do all the things, right? We're not just like limited to, our residential like home sales, right? Which is why you're on here, because we get to talk about all the things lending.
Yeah.
Yeah.
We help a lot of entrepreneurs, have for 20 years.
Very cool.
On all 50 states currently. Commercial, residential, vanilla loans, chocolate loans, and then of course Rainbow and Rocky Road.
All the Neapolitan-ness of lending. I like it. Right. Yeah. So then let's just jump right into it. Yeah. So like, what's the difference? So if you are an entrepreneur, if I'm an entrepreneur, I think, man, I got no money. I got nothing going on. I've got a business plan and like a dream. What would my next steps be in something like that?
I like to think of it as a waterfall.
Okay.
So you make plenty of money in reality and on your tax returns. We're going to use your tax returns.
Ooh.
You make plenty of money in reality, but not on your tax returns.
Okay.
We might use your bank statements.
Yep.
We might use a profit and loss or a 1099, something like that.
Mm-hmm.
And if you don't make money in reality, but have a lot of money, it's called a no ratio option, where you're not demonstrating income. So it's not stated income of days of yore.
Right.
But it's a limited documentation. We document assets and not so much income.
Okay.
So there's kind of a waterfall. Full documentation, tax returns, less documentation, bank statements, or zero income documentation, and you better have some money.
You better have some cash sitting in the bank.
Correct.
Do you have to explain where the cash came from? Or
If I please don't steal it. Yeah.
I was going to say, do we need to talk about the barrel at the bottom of what is that, Lake Mead or like?
Oh boy, are we in Jersey?
But we are pretty close to Vegas, so
that's true. Yes, no, please don't. Yeah,
please don't do that.
Please don't.
So let's pretend that is the case. How long should it sit in your account before those questions arise?
Fair question. If we are anytime large, after the meltdown and all of the regulations that have changed over the years, if you are evidently funding terrorism, currently in our current state, marijuana, right? You can't, that's a niche, right?
Yeah.
So if there's large deposits within the past 60 days, that will come up where that money,
like
where that paper trail come from. If we are doing bank statements as documentation, that's going to be 12 months of bank statements. So large deposits will get, inspected.
Within that 12-month time frame.
Or 24, but
right.
Generally.
So it's interesting you bring up marijuana because we just had Dimitri Downing on last segment.
But he's a marijuana entrepreneur?
He's like basically wrote the legislation for Prop 207 and is the founder of MITA, Marijuana Industry Trade Association. And so very, very involved in, that process. And we talked about the commercial real estate involved with marijuana as a business and that we called it the marijuana tax, right? Because it's like you can make a lot of money if you have a lot of money. Right. But there's no financing. And I was telling them the story of a triple net building that I found for an investor I had. But when we called the lender was like, yeah, that's a no-go.
Hard no. Yeah. I'm seeing actually marijuana entrepreneurs go out of Phoenix Metro.
Really?
I recently talked to a guy who had bought a building in Superior.
Yeah.
No, not Superior. Miami.
Okay.
Like even more deserted. Miami, right? Very large, old commercial building, been deserted for a year. Very cheap.
Yep.
And so he got his license out there. And so I think they were going to grow there, but they were going to process and retail and ship, I think.
Okay.
So, but it was, a $300,000 building that was, ginormous.
But isn't the way that the lottery was pulled or whatever it is, the licenses work, they have to be in that county, right? Or in that in that bubble,
I'm
something
not
like that.
really a specialist there. I think that's right.
I think it is too.
Part of me wants to own one because those guys are printing money.
Right.
But I don't smoke it. So, But,
well, Dimitri Downing said he didn't smoke it either, but he wrote the legislation for it and created the whole association because he believes in freedom of choice, right?
I get that.
So that's interesting because so the lotteries all got pulled, the licenses got pulled, and they're limited. That's it. That's all we get in Arizona. So I think they said there was 138 of them.
Is that right?
Which means there's only going to be 138 marijuana-related businesses in the state of Arizona.
So, I feel like there's 138 in Mesa.
Well, and I'm not sure where like the transfer of medical to recreational went. Right.
Selling,
yeah.
all the different stuff. Sure.
Yeah. I mean, we as a brokerage handle some of that, but we have people that are smarter than me that are taking care of that.
Or more stoned than you.
Well, maybe.
Yeah.
I don't know. We'll see.
I'm kidding.
So I mean, that's really interesting, right?
Yeah.
And another thing I recently learned that is a really boring fact, but fascinating to people like us, is limited use, drive-throughs, stuff like that. I had a contract.
Like specialty use properties, very difficult to finance. Yeah. Laundromats, exactly. Right?
That's so interesting because in my brain, as long as like the cash flow works out and the numbers all work out, it's financeable. But we got told we had a Jiffy Lube under contract for about $2.5 million, and the cap rate, it was about 5.5. Super steady, tenant, right? It's flipping Jiffy Lube. There's like 20 years left on the lease. Like it's beautiful. It's like got a bow on it. And I learned from the lender because he was trying to get financing on it, he was like, no, it takes 50% down because of the limited use. Basically, if this tenant defaults and we have to go find a new tenant, then that is a slower boat than, say, an office building.
Think of it this way. Like in an office building, you can plug in a CPA firm. You can plug in myriad businesses.
Right.
But, there's not going to be a flower shop that's going to go build themselves in a gas station.
I mean, they could do well.
Well, I've seen it done, actually, truth be told.
Right.
But yeah, it's
right.
Because it's a super niche specialty building. Like so you've touched on, because there's 4 C's to any, I like to think of a mortgage as a stool.
Okay.
With 4 legs, the 4 C's of a mortgage: cash, collateral, character, and credit. Right.
All right.
So now we first started out talking about cash, right?
Right.
Where is your money and how can I document it?
Right. How are you going to pay for this?
Right. And how much do you have down payment? Right. And how does your income work? But then collateral is the next one. Right. Because you've got funky collateral. Like I have a client that came to me to finance, and they have existing board and care facilities, single family residence, 10-bed, right?
Oh, right.
They have 2 existing, and they came to me wanting to acquire another one. Well, that doesn't work for a Fannie Mae loan because A, it's a business, and B, it's special use, right? It's special running, special licensing. And unfortunately, they chose to go down the road with a different mortgage individual, but they've already had the door shut, right? But it's specialized collateral.
Right.
And unless you're going to be sneaky and do something, hope that the lender closes their eyes or misses something,
right?
You're going to get stuck.
Well, then you're messing with people's livelihood, right? Their license and things like that. So elaborate on the other 2 C's. So you just cash,
credit,
right?
And character. So character is really reflective of people's credit, right?
Okay.
Because, in today's mortgage underwriting, right? It's very cut and dry.
Right.
It's very not subjective.
Right.
Right. Very rarely is the underwriter saying, Carla.
She's a nice gal.
Right. Oh, yeah. So character's really reflective on credit, right? What does your credit history look like? Public records, payment history, that kind of thing. In some commercial financing, SBA specifically, if you've had certain types of legal infractions, those are problematic. I had
that sounds fun.
I had somebody who had domestic abuse issues.
Oh.
So that doesn't work.
Right. Well, and let's pause that. Let's tell the audience what SBA financing is.
Small Business Administration. So in general, in the mortgage business, whether it's residential or commercial, there are government-backed FHA, VA, USDA on the residential side. SBA is kind of that same equivalent on the commercial side. And then there's conventional, which can be public or private. So like Fannie Mae, Freddie Mac, conventional, right? And Fannie Mae, Freddie Mac, or Fannie Mae does conventional commercial as well, but conventional residential. And then there's private conventional, non-prime, not non-QM, we call it today, prime jumbo, anything that's private and not going to any government-related institution. So that's kind of the two differentiators, all government-backed or public-private partnership.
Right. So I think when I always think of conventional, I think of traditional. That's what the word comes to mind. It's the loan everybody thinks of.
But technically a non-QM, a bank statement loan is technically conventional. It's just conventional private.
Got it.
Yeah.
What does QM mean?
Qualified mortgage.
Oh, okay.
So after the meltdown, right? So
I love how you call it the meltdown, by the way.
And we called it. Remember the implodometer? Yeah, I don't know if you were were you in the business back then?
No,
oh yeah, there was a mortgage company implodometer, and like,
funny.
First Franklin, right? They died today. That was my company. Oh, it was a great company. I know, right? But when the meltdown happened, things that were legal to do back then, were perceived. Well, they were.
Yeah.
Like you and I could sell the same individual, and it would always be something like this: a white guy and a black guy, 640 credit score, and we priced those loans differently.
That's so crazy.
Or we documented those loans differently.
That wasn't that long ago.
No. And so I've never felt good about, like, there were individuals back then that would gouge somebody who wasn't as financially sophisticated or savvy. I never felt good about that. Right. That just wasn't the way I wanted to conduct my business. I wanted to do a great deal for you and have you tell all your friends.
Right.
So my phone just rings. It has for 20 years. Right. Imagine that. But
it's not your sparkling personality. It's the actual business skill.
It's that too. They say I have a face for radio. I guess we'll find out.
Well, why do you think I have a podcast?
So anyway, back to business.
Yes, my bad.
It used to be that certain things were acceptable, but they put borrowers in negative positions.
Okay.
For instance, interest only.
Oh, yeah.
Right? Negative amortization, where you're paying less than a full payment. Prepayment penalties. All these things that are now no longer legal. So, and then through the revision that started after the meltdown called Dodd-Frank, has come something called a qualified mortgage. Back in the day, you as the borrower could sue me as the lender and say, yeah, you just gave me all this money, but you took advantage of me.
Oh. Okay.
A qualified mortgage presents a barrier to you suing the lender and therefore sets certain standards by which it's acceptable to say, sorry, borrower, you knew what you're getting into. You got a qualified mortgage, right? So it's a legal definition.
Interesting.
Non-QM is today's subprime.
Got it.
Right? So yes, you could still assert, but there's still boundaries within a non-QM as well.
Right.
Right? So any negative features like interest only, negative, all that kind of stuff. Right.
So is that where the more like private lending comes in? Right. And I think private lending is commonly referred to out in the open market as like hard money and things like that.
Okay, so that's a very broad term.
Right.
Right. So mortgages, most mortgages get bundled together and sold into a securitization or a bond structure.
Right.
And so there are private securitizations, right? And then there are public securitizations. So Fannie, Freddie, Ginnie, right? FHA is Ginnie Mae. Fannie, Freddie, Ginnie do government-related securitizations, but non-QM loans do private securitizations, right? So private also means, hey, I'm going to call Uncle Bob, and Uncle Bob's going to give me a first trust deed.
That's true.
Right? I've had to make referrals to people like that in certain times, right? Where for whatever reason, there's something that comes up. Hey, I've got a private lender who's literally making his own decision and, sending you $500,000.
Right. Uncle Bob sounds like a sugar daddy. Just saying.
I don't have one of those. Never have.
Me either.
Yeah, right?
Which is
Where's
why
my trust fund?
It's because I have a face for radio. So going back to like SBA loans, like let's talk about what those are, because I feel like they're popular, maybe not common, but popular in the business world for commercial lending because you have to occupy the property, run your business there. What kind of qualifications or what kind of standards are in those loans?
Yeah, so generally speaking, SBA is more costly than doing a conventional loan.
Interesting.
But it has a way more flexible underwriting process, right? So you can, do little down to up to 10%, right? So that's helpful. If you're a startup, they can do projection-based, Like, in other words, if your resume is strong and you're a great real estate agent, and now you're going to go start your own real estate brokerage and you've had a history and blah, 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 right? So you can do a projection-based acquisition of a building. Like, hey, we don't have 3 years of history.
Right.
But we're really good and we've got so-and-so's resume and we've capitalized and all that kind of stuff. So you can do something like that for a startup. So that's a flexibility. Oh, you had a bankruptcy? Okay. SBA is more lenient on that. Different types of credit scenarios, income scenarios, way more flexibility, but has to be owner occupied, right? And by owner occupied, that means 51% of the structure has to be owner occupied. So you can still have a tenant, right? That offsets part of your rent, right? And that's, the reason people do it, or one of the reasons that people use SBA. A more conservative, like a conventional loan, is gonna require, generally speaking, 3 years of filed tax returns for your business, personal tax returns, get personal guarantees on anybody who's a partner of generally 20%, if my memory serves me well. And then there is, conventional, but out of that box.
Right.
So like for the triple net property that you're talking about, that would typically not have a personal guarantee. And while it's special use, you've got a credit tenant in a Jiffy Lube franchise, right? Somebody that's very established name, that kind of thing. Because the Jiffy Lube itself is a saleable asset. Right. The building and then the franchise that operates in the building are saleable assets. So those are kind of some of the differences of why people choose a conventional commercial loan versus an SBA commercial loan. Right. Generally speaking, it's flexibility on down payment, credit events, things like that.
That's interesting because I have a property for sale in Phoenix, right in the Paradise Valley submarket. And it was a physician that was in there. He's moved out of state. And so we've left part of the building empty and not leased it out so that somebody can qualify for that 51% like you're talking about and have a turnkey medical practice, right? All the exam rooms are already built out. There's a physical therapy office already built out. And to qualify for that 51%, there is a storage suite. Right, that he occupies, and but it's his
records and
all kinds of stuff, right? Old exam tables, things like that. So, but the rest of the property, the other 49%, is occupied by a variety of tenants. Yes.
Yeah.
So
and that's a common thing for physicians, dentists. They generally make great money, but they also buy themselves high responsibility jobs.
Right.
So oftentimes the way those types of entrepreneurs will grow their wealth is by then acquiring the building, right? The other things that come along with it.
Right.
That support the business, grow their wealth, offset their cash flow by having tenants in that 49%, right? So the strategy piece.
Right. So they're diversified in not only the business portfolio, but the financial portfolio as well.
Antennas on their rooftops and maybe the vending machines or whatever they all are.
I don't remember where I heard this actually. There was somewhere where the SBA loans, and I can't remember if it was for physicians specifically or if it was just for anybody, but if you added solar to the building, that there was some kind of financial benefit to the loan, but not if the solar was already existing. And I wish I remember now what that was called. No.
Super niche-y. Like I know that comes to mind more residentially because people always want to finance their solar in their loan, in their mortgage. It's difficult to do unless your builder on a new home is adding solar.
Yeah.
I don't know that specific niche.
I don't either. And I'm trying to remember because he paid for the solar, this particular physician that I have the property listed for. Yeah. And it's paid for solar. It's a great building.
It's owned, not leased.
Yeah. Yeah. And it's everywhere. It's all over the top of the building, all over the parking structure.
And tax credits, obviously.
Right.
Doctors making hundreds of thousands of dollars a year need to offset.
Right. Yeah. Especially because he was, a surgeon too. And he moved to Hawaii, which are, terrible problems.
All your female listeners are going to ask if he's single or not.
All the female listeners, he is not single. I'm like, wait a second. Let's clarify that question. He's happily married with 2 kids living in Hawaii as a surgeon. Yeah. His life is not right. His life is not frustrating, and I'm happily selling his almost $5 million property.
Sure,
right in the Paradise Valley submarket.
Yeah,
right. So, what other interesting trends are you seeing in commercial financing? Like, tell the listeners what like a common interest rate is now. Interest rates are a huge topic right now,
Well, they've
right?
been going all over the place.
Right.
In a rising interest rate market, ARMs become more attractive. Obviously, it's not uncommon for commercial to have, to be on the balance sheet of a bank. That does happen sometimes.
Mm-hmm.
And so like local lenders are sometimes a good go-to.
Mm.
They will almost always have adjustable rates, right? You're going to find your fixed rates that are some sort of Fannie Mae or SBA product. And rates are creeping up just like they are on residential. So they're getting in the 4s and 5s. And if they're special use or they're unique scenarios, you can see I'm refinancing a 7% interest rate right now. Somebody who's a great business owner.
Right.
But
they just had to kind of take what they could get.
Well, they had a bankruptcy.
Yeah.
Within a 7-year period.
Right.
And so they had to take an adjustable. And when it's an adjustable, it's going to be the full margin.
Mm-hmm.
That's where the lender really makes their money, is in the margin.
Right.
Yeah. So we're getting out of a 7 into a high 4.
Yeah.
On a 25 AM.
So an ARM loan for
adjustable rate mortgage.
Right. For those that aren't
ARMs and farms.
That don't know what they are. Yeah. They are a mortgage that have scheduled increases in the interest rate, correct? And then therefore in payment.
Correct. So an adjustable rate has an amount of time that the interest rate is set.
Mm-hmm.
The interest rate is set based on a particular index, prime, LIBOR, cozy, coffee, there's a bunch of them, plus a margin. And that margin is the profit that the lender makes for taking the risk of lending you the money.
Right.
And then the 3, 5, 7-year, 10-year fixed rate period, after which it can go up by a specified amount in a specified time. Sometimes it's 6 months. More often, it's usually 1 year or 5 years on a commercial.
Right. Well, and then and let's be clear for those that are listening that maybe don't understand how this works, right? Yep. The lender is not you. You are a broker, meaning Correct. You are putting a lender and a client together in a happy union and providing them documentation.
Matchmaker, make me a match.
Just like we are real estate brokers, we don't hold the real estate. We are, marketing for our clients or helping them acquire, right?
Yep.
So I think sometimes when we say talk to the lender, it's like kind of a generic term, and that I could mean you or I could mean.
So let me specify
right.
the difference between a mortgage broker and a mortgage banker, right? A banker. A banker is the lender. They're lending, quote unquote, their own money, right? Their own money can be from their balance sheet of their bank. More common is where a loan is funded and then immediately sold to an investor, right? But it's funded in the name of the lender. So the mortgage bankers or lenders lend, quote unquote, their own money. A mortgage broker lends somebody else's money.
Right. Like I said, the matchmaker, right? Yep. The happy middleman.
Yep.
So in the crash meltdown era,
yeah.
we had an ARM loan on our residential property.
And you were probably very glad.
Right.
Because rates went down, 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 down.
Right.
Yeah.
And but that is also why we had to short sell our property, because then when our ARM came due, right?
Did you have an interest only?
I think so.
Yeah. So interest only is
crazy 2011.
An interest only, like, hey, you only have to pay this much for the next 10 years. But wacko, you get hit with a baseball bat come year, month, 10-year, 1 month.
Right.
Right. Because now you're suddenly amortizing over 20 years and your payment goes from here to here.
Right.
Hence, this is no longer possible.
Right. And so.
Well, I won't say it's impossible, but it's not possible in a traditional qualified mortgage world.
Right. And what happened back then during the meltdown was that's fine. We'll just refinance it. Well, you have no value left in your house. It's underwater $100,000. We're not going to refinance that. So when we start talking about ARMs in today's current climate, I always start getting a little cautious and a little nervous about, that kind of speculation that everything will at least stay steady enough to, to carry an interest only or an ARM so that doesn't happen to anybody else. Can that happen still? Like say you bought today and then you have no value, right? And you have an ARM that balloons and you want to refinance it, but
well, we've got a different set of circumstances.
Right.
Right. So we had very easy money.
Super easy.
With no skin in the game. Right?
True.
I don't care what kind of loan you're getting. No loan is easy today.
Well, if you've bought a house in the last couple of years, you know that.
There's work. I mean, I back then, literally, my record is closing a loan in 4 hours.
That's dumb.
Crazy.
That's insane.
I agree. Right. But fell apart with somebody else. We played cleanup with an appraisal and blah, blah, blah. Right?
Wow.
So, no loan is easy today.
Right.
You're going to have skin in the game.
Mm-hmm.
I mean, unless you're in residential, maybe you're doing something, like a down payment assistance or something like that.
Right.
So, A. B, housing. And you're talking housing, right? We
right.
to housing. We had a glut of supply and lack of demand. Mm-hmm. So the exact opposite of what we have now in 2022, we've got no supply and crazy demand.
Right.
Right. And we've got all these folks that are moving, to our state, especially here.
$250 a day.
Isn't that crazy?
That's to just come to little old Phoenix.
I know. And I live in Gilbert, and I look around like, okay, where'd my little old town go?
Oh.
And I didn't even grow up here.
Right.
I grew up in Orange County. Yeah.
So you're one of the Californians that came over.
I California'd your Arizona.
I know you, and I'm pretty sure that you did not California or Arizona. I think just your birthplace is all you can claim on that.
And my 714 number.
Oh, you still have that.
Yeah,
I still have my Seattle number,
years.
so I get it.
Yeah. But what I was going to say was, so we've got the exact opposite. We've got no inventory. Mm-hmm. So yes, rates are rising, and rates are rising intentionally because, we've had this run up in market. I mean, granted, you can't have fiscal policy that prints trillions of dollars and not expect those dollars to be worth less. Like, I don't know what the thinking was there, but whatever, here we are.
Right.
And so, but we've had this crazy run up because of COVID, right? Of prices going up 30 offers and $100,000
like
over.
Literally exponentially.
Yeah. I mean, I have clients in Orange County that are offering $300,000 over list price and losing.
Oh, yeah.
To somebody else with cash.
Well, last year when I was helping out a couple of residential clients, I mean, I call it bidding because that's literally what it is at this point.
But so that's why increased rates is actually good.
Yeah, it had to slow down.
It had to slow down. And if I'm a seller and there's nothing to buy, right? So what we're seeing rising inventory rates.
Yeah.
That's good.
It is good. And just to so that nobody panics. Yeah. By rising, I think when I checked yesterday, it was like 7,200.
Which is not, it's barely
listings on the MLS, and it should be like 20,000. So before anybody writes into the show, slow down. Yeah. We're still
we still have a healthy seller's market.
Very. And honestly, if you listen to
Cromford.
Thank you. The Cromford Report, who is a very hyper-local, analytic real estate platform. We've only had one not seller's market in the last 20 years. And,
the meltdown.
Right. It was the meltdown. And it was like a blip. It was a minute. And the way she explains it is really interesting because she's like, what people actually want is a balanced market, right? Mm-hmm. Everybody thinks they want a buyer's market, but they don't, because what happens is if you move into your house today and it's worth less tomorrow, that's not good. Nobody wants that. Yeah, we have, haven't we? Mm-hmm. And so what we really want is a balanced market. Like, I can put my house on the market and maybe go contingent on another offer on a house that I've seen a few times and actually got to go inside before I purchased it.
Didn't have to offer blind.
Right?
Yeah.
That's what a balanced market looks like. Like, I have a choice between this house or that house. Do I want the 3-car garage or the 2-car garage? It's not take what you can get, right, folks. Now. Everybody out for themselves.
Well, and so, because Arizona is affected by California, I listen to and read a lot of different info, right?
Yeah.
And so, for instance, in Orange County, Southern California is booming, right?
Still.
People are moving out of LA, out of San Francisco to go to Orange and San Diego.
Interesting.
Mm-hmm. And an individual that we have many mutual friends in common. I don't actually know him, but he's in the top, I believe, 10 agents in the entire country.
Okay.
So if you want to buy an oceanfront, $10, $20, $30 million property, Tim Smith in Newport is your guy.
Okay.
He's one of the few.
Yeah.
And for every one that he lists, he's got at least 2 buyers at that price point.
That's nuts.
Well,
that's a lot of money.
Well, international folks want to park their money somewhere.
Right.
California beach real estate.
Well, and if I have to park my money somewhere, my millions that I'm trying to figure out where I should put, obviously I'm going to put it on the beach with beautiful views, right?
Right.
Yeah.
So that means that the average individual, the average wage earner, right?
Right.
In Orange County is way getting priced out.
Yeah.
And, obviously there's a whole political conversation. Maybe they want to leave anyway.
Right.
But if so that the number one place that people are coming to Arizona from is Southern California.
Specifically, like
Correct.
out of all the California,
Correct.
specifically Southern California.
Correct.
I also joke being from Seattle and first moving here in 1996 that, not to date
You were
myself
10.
too much, I was like 5. Who are you talking to?
Oh my gosh, I'm a millennial.
That I swear there is a tunnel from the Pacific Northwest to Arizona, and people just like quietly go back and forth because they're like so far off the radar. Everybody's so mad at California and blaming California.
You've been Californiaing my Arizona.
That they like are like, wait, Washington's moving here too?
Right.
Oh yeah, by the drones.
Yeah.
Yeah, like secretly they're like hiding behind the Californians as they march.
Well, I mean, Seattle's even worse than Orange County. I've heard horror stories of $600,000.
Oh, I still have friends that I went to college with up there that are in real estate that like the things, like, for example, the house my husband and I first bought, our very, very first house, was in 2005. It was a 1,000 square foot, 2-bedroom, 1-bath house that had never been updated. And we paid at the time like $200,000 for it.
6, 7.
It just sold, like, then we flipped it for like 300, and then
8.
And then it like bottomed out.
Yeah.
And now it's, like 600,000 for this. And it's not even in Seattle. It's in Marysville, Washington. So shout out to Marysville.
This is why higher interest rates are actually
right. We need to slow that down.
Right. We need to slow that down. We need calm to come into the market. Right. I mean, obviously inflation with other stuff as well. Right.
Yeah.
Fuel prices and natural gas and all the other stuff. But so higher interest rates is actually going to give sellers an opportunity to breathe, buyers an opportunity to choose, and the market to come back into a little bit of normal.
And this is not unique to residential real estate. In the commercial realm, we are also struggling with finding properties for our tenants to go into that have great business plans or have current businesses, franchises, things like that. We cannot find them property. And every day what do you do? Oh, I sell commercial real estate. They're like, oh, sad about those office buildings. I'm like, I don't know what you're talking about. Like, I don't know what news platform is reporting that, but it's not what's accurately going on here. Yeah. I think it's an assumption because people got sent home during COVID. But I think what we're finding out too is there's a lease on that they're still paying for.
Oh, I mean, Class A office space in Gilbert with, Deloitte printed on it. I don't think they're defaulting on that lease.
Yeah, they're not going to default on that.
Those parking lots are empty.
Right. So guess what? Now you're going to start coming back in the office because we're not paying tens of thousands of dollars per month for
productivity. There's a conversation around productivity and all the stuff.
I think so too. And I think people are realizing 2 things. One, like, oh, wow, we actually could have loosened the reins a little bit on our employees. They actually did still work. My bad. Right. But that number 2, they're starting to see after 2 years, the like disconnect between collaboration. And so I think what's happening is kind of like a hybrid model is going to start coming into play, like a weekly meeting or something like that, just to all kind of connect together and so that they can still get that synergy together.
I prefer working in an office, honestly.
I do too.
Yeah. But home. Office.
Yeah. Well, that's because at home, even though I have an office, I work at my kitchen table and I yell at my dog, and the kids are like writing Post-it notes to me if they can watch YouTube, and can I have more time on my phone? The dishes need to be done. Right. And I'm just like, you know what? I'm going to go to the office because this is so much easier and quieter. But you know who I work with. So that's actually a big fat question.
Yeehaw, cowboy.
He was on my first podcast here.
That's what he said, actually.
Yes. My broker, Aaron Dutcher.
Yeah.
He's a good guy. Yeah. And
colorful.
I am. I'm going to publicly tell you I'm going to crash your lunch. So as we're... Aaron, beware. Here I come.
Are you listening?
He better be listening. So is there anything else that you think the audience should know, misconceptions about lending, finance, anything like that?
I don't know about misconceptions, but planning is so key, right? Like, especially, most entrepreneurs, entrepreneur business owners, will defer their taxes. They'll extend until October. But planning is so key. What?
No, I didn't extend mine at all. No, God, no.
Is your nose growing?
It is. Kids bumping the microphone yet.
So planning, like, great mortgage people speak CPA. We have to.
Yeah.
Right? And so an ounce of planning goes a mile. It just does. So you know what you're ready for. And I don't care if you're buying a house first time or your 10th house or a building or your 5th building.
Yeah.
Right? You just an ounce of planning.
I would even argue to say that goes for all business owners in any space, even like the tenant rep space. I mean, I have a really fantastic business owner right now who is a physician and kind of has like another business model she wants to work on. And I tried to tell her, you need a business plan, you need, all these things. And
no, I'll just write a check. I'm rich.
Pretty much.
Yeah.
And so she found this space in Gilbert that she wants really bad. And I reached out to the broker and he's like, where's her business plan? Wah, wah. Sorry,
Personal
we don't
guarantee
have
and a bunch of money?
Right. And nope, not right now because things.
There ain't nothing.
Yeah.
Don't I sound sophisticated?
That was literally the one lease space that she would fit in like the whole town of Gilbert. Right. The Southeast Valley right now is so hard to find anybody, anything, even a built-to-suit pad or even to purchase. Like every day we are getting calls from people that are like, I want to be in the Southeast Valley. Like look through Queen Creek. All that's there is residential properties. There's no second generation commercial properties at all to even take over
so that
to buy
starts
into.
To push people back into the core, right? Tempe, Mesa, and regentrify, so to speak.
Right.
Take old ugly, which there's plenty of in Mesa, right?
Right.
And to figure out how to make it.
That's not very nice to call me old and ugly in Mesa. I'm just saying.
So I grew up in Santa Ana, California,
right?
Which the zip codes are 92701 to 92705. Right. I always say Mesa's just like Santa Ana. Yeah. There's 9270 ghetto and 9270 fabulous.
Oh my God, it's true.
It's true.
And that's so interesting you say that because that is what we're seeing in Mesa right now. And it is because Gilbert's full.
Yeah.
Queen Creek is like under construction. So where's the next logical place?
And Gilbert was also very forward-looking when Mesa was asleep 20 years ago.
Right.
Right. So they didn't plan and think and invite and do tax incentivized deals like Gilbert did.
Right.
So there's, you gotta make the opportunity.
Right. Well, and like now they are. I feel like Mesa, the mayor, who we've invited to be on the show, just saying, has done, in case he's listening, has done a really good job the last few years and is really taking advantage of the, what would you call that? The corridor in East Mesa, the tech corridor, and really kind of establishing that and putting their stamp on it.
I feel like there's like secret government buildings out there. What are all those things?
I know, right? They're just like big shells of.
Yeah. And they're all like these sexy, modern, like, what goes on in there?
I don't know.
Mystery.
We should find out.
Should we break in?
Shh, no illegal talk on the podcast.
No, I would never.
Never. But, and then because of that, like just urban sprawl in general, you will now see gentrifying areas of Mesa because you can't get into Gilbert. You can't get into certain areas and there's plenty of space so far. It's it's narrowing.
Well, like I have a friend, a client who's become a friend, who sells clocks on Amazon.
Okay.
Great rocking little business, right? And they assemble and all this kind of stuff. You would never know where their building is in an obscure part of not sexy Mesa.
Yeah.
And yet, millions of dollars a year selling clocks on Amazon.
Well, I can tell you I have a client that I've been looking for a warehouse space to lease for them in Mesa. And it is almost as impossible as finding office space in Gilbert because of, that type of
all
business.
The new flex space that's right along Germain, right on the Chandler-Gilbert border, that's all spoken for.
Yep.
And if you notice, it's all like Class A with names that you recognize.
Yeah.
Same thing in all the opportunity zones out by the airport.
Oh, yeah. So for the listeners, Class A, B, and C, right? Class A is like your brand new, sexy. Oh, yeah. Those are nice buildings. That's what you see in like Tempe and Scottsdale. And those really get commercial brokers' hearts racing. Class B is like probably, it's the next step down. It's like she's pretty from 10 yards.
Don't talk about my car that way. You're talking about a car, right?
But that's your Class B. And then your Class C is what you're traditionally thinking of in like some of your older areas of Phoenix and Mesa and
927 ghetto.
Lower income and things like that. But yes. So think Class A is Scottsdale. We'll call Gilbert Class B. And you should see his face. And then we'll call Mesa Class C. So just so that you can like picture that frame of reference. And then there was another terminology you used. Now remember, because now I'm laughing.
Sorry. Well, but what I have seen folks doing, like I have a great 3 brothers that own an engineering business, like, I don't know, $5 or $7 million, great guys. And So they need space. Well, but they're scrappy, right? So
They the brothers or they the business?
The brothers are scrappy.
Okay.
So they bought a trailer on like a 2.5 acre parcel that had an outbuilding that would be a nightmare to finance residential. Right. Yeah. Trailer built in 72.
Right.
Right. And so they've because it's already county island, so they can run a business on there. So sometimes you have to think outside the box. Right. And it was relatively, less expensive, inexpensive. Comparatively. So, sometimes you got to think outside the box to find it, depending on what your business is.
Right. Well, and that's where, to toot my own horn, that's where a good real estate agent comes from. That's one of the reasons I'm so busy, is because the good ones have the ability to think outside the box and go, okay, I understand what your needs are, and let's look at it from like a different perspective. And so we're still addressing what you need, but within your parameters financially or whatever. And then likewise, a great mortgage broker kind of does the same thing. Like, I know you came to me for this, but let's think about these options or, what we can do. And understanding all your programs and all your products is really the benefit to that. So to start wrapping this up, how can people get a hold of you for and what needs? Residential, commercial, like all the things?
Yes, all the things. So 480-400-LOAN is our office line. That's 480-400-LOAN. 480-400-5626.
We need a jingle. Just
Ken Starks, KBYU-FM News. There's my radio voice. So that's our office line. It's textable. It's callable, right? Our team will answer. TheStarksTeam.com. You can just hit the little, the little scenario button. What do you want to do? Tell us what you want to do. And so that's how you reach us. Or new loans at TheStarksTeam.com. And so, I'm sorry, you said that. You said something else too.
Oh, I just wanted to hear like how people can get a hold of you.
That's how you get a hold of us.
Yeah.
Yep.
Do you have an Instagram?
I'm bad about Instagram. I do. Right. I do have an Instagram, but I'm just at Ken Starks. It's kind of, you're going to see my kids, my dog, my house. You might see my 66 Lincoln, and you'll learn mortgage stuff too.
Right. It's not like my Instagram, Investment Real Estate AZ, which is super professional. And I work very hard on it.
Are you saying I need to up my Insta game?
Need to up your Insta game.
Wow, I think I'm offended.
I like yours because I can see you. There's things I obviously didn't know based on our earlier conversation.
Right.
But
yes, I'm single.
Oh my God. Yes, ladies, he's not taken. Top 1% mortgage broker and single. Just saying.
Oh boy. Oh boy. Please be more.
Oh my God, the phone is ringing off the hook.
Oh my gosh. Please be LDS and have something of your life, like a career.
Like have something to provide. So no trophy wives?
Trophy is an eye of the beholder.
Or the eye of the
might
trophy.
Be trophy. Yeah. Eye of the trophy to me. The trophy might be different for me than it might be for somebody else.
Right. So ladies, Ken says his requirements are LDS. And that you have something to bring to the table, right?
That sounds really bad.
Well, no, in terms of like, okay, we're going off the rails here, but in terms of like brains, business acumen, like, right? Like we're at a point in our lives where we're not dating each other because our butts are cute anymore, okay? Like, there has to be some substance here. Otherwise.
I'm going to call HR on that one.
Good thing I work for myself. Oh, great. She answered. She doesn't care. So that's how you get a hold of Ken at thestarksteam.com.
Thestarksteam.com, 480-400-LOAN.
Well, thank you so much for coming, Ken.
Thanks for having me. It's been a blast.
Yes.
We really should do this more often.
We should.
Do you come here often?
I do come here often. The first and third Friday of every month.
Don't tell Richard.
You've been listening to Smashing Through Walls, a place for robust conversations about the building and blocks of Arizona commercial and real estate investments. Host Carla McGee is a commercial real estate broker with MHG Commercial, powered by My Home Group. The opinions expressed here are not necessarily the opinions of My Home Group and do not constitute any offer or advertisement of business or services. The real estate market is cyclical, and listeners assume all responsibility should any return on investment, tax consequences, credit effects, or financing terms not meet their expectations. Guests may not be qualified to provide financial, legal, or tax advice regarding a real estate transaction. Listeners are advised to obtain professional tax and legal advice and counsel.